welcome to KYC, that is Know Your Company, a show designed to give regular investors powerful and actionable insights into fundamentals of a single NSE-listed company every day. Today on Know Your Company, we are going to talk about Titagarh Rail. Just a brief about what the company does and where the company's revenues come from. The company was incorporated in 1997. It specializes in transportation solutions. That includes your semi-high-speed trains, urban metros, as well as passenger coaches. In terms of the overall market share, it holds around 25 to 30% market share in wagon manufacturing. In terms of designs and manufactures wagons, it does design multiple wagons as well as overall designs in terms of container flats, grain hoppers, cement wagons, clinker wagons, also tank wagons. And the company has business interests in shipbuilding, bridges, as well as defense. In terms of order book breakup, well, companies almost 43% of order book consists of freight rolling stock, and around 57% comes from passenger rolling stock. In terms of its manufacturing capacities and capabilities, the company overall has 4 manufacturing facilities, 2 in Titagarh, 1 in Uttarpara, West Bengal, and 1 in Rajasthan. Overall, in terms of its capacity, overall wagons has around 12,000 per annum, coaches is around 300 per annum. In terms of traction motor, that is 2,400 per annum, and liquid metal is roughly 30,000 MTPA. So this is with regards to what the company does and how the order book breakup is and how the manufacturing facilities for the company are. But in order to determine how the company is performing financially and in terms of what shareholding looks like, we're going to go through 8 different parameters. The first one being the income statement. Then we'll also go through the balance sheet as to how things are faring out for the company's balance sheet. Then we'll talk about how the return ratios are for the company. We'll also talk about how cash flows are panning out for the company. We'll also talk about how shareholding breakup is for the counter. We'll talk about what street cred looks like, how the stock performance has been, what the street coverage is, what our analysts talking about the counter. We'll also talk about how the company is placed as compared to its peers in terms of valuation. And lastly, we'll also talk about what the management guidance is, what is the outlook given by the management. And in order to discuss all of this, we're also joined by Anushi Vakharia, who tracks the space very closely, and she will take us through how the income statement is right now for something like a Titagarh.
Right, thanks for that, Mahima. So if you are looking in terms of the 3-year picture, in terms of how the revenue has shaped up, firstly in FY22, we did see a 3.5% of a revenue decline. But since then, FY23 being the softer base for the company, considering FY22 performance, we are looking at around 89% of a growth in terms of revenue. And FY24, that has continued with a growth number of around 37%. Even the margins, they have ranged from the 9 to 11 to 12% mark that we are looking at, 12% in FY24, while in FY23 we did see 9% of margins over there. So overall, considering the 3-year revenue CAGR, that stands at about 36%. In terms of PAT CAGR, we do see the 181% of growth number, but do note that FY22 and FY23 21 are not the comparables for the same. That is why on the softer base, we are looking at a higher CAGR growth number as well. In terms of how the 9-month FY25 picture has shaped up now in this year, so far we have seen a 2% of a revenue growth for the company. EBITDA margins have seen about a 30 basis points of a decline, while net profit has seen about a 6% growth. Now, concerns on the Q4 and the Q3 have been on the offtake in terms of the wheel supply from Indian Railways that had been pointed out before on how this could lead to the revenue growth of the company. So that is something that we should be watching out for the 4th quarter performance and how the overall FY25 will shape up for Titagarh Rail as we speak. In terms of where the order book positioning is concerned, now so far in 9-month FY25, the company had received 1,106 crore worth of orders. The order book standing at about 12,000, almost at 12,000 crore mark as of December 24, and this orders also include 13,689 wagons and 1,589 Metro and Vande Bharat coaches as we speak. So this is the overall breakup that we are seeing in terms of where the income statement is concerned. But Mahima, let's also talk about the balance sheet, right?
Right, absolutely. So in terms of balance sheet, where the equity share capital is concerned, it stands at around 27 odd crores rupees. That is remains similar as compared to FY25 as well, H1 FY24 as well. In terms of long-term debt, it has decreased a tad bit from that 37 crores to 31 odd crores. Short-term debt has significantly gone up in first half of FY25 to around 365 odd crores, and this is because of probably working capital requirements that the company might have taken short-term borrowing to kind of fulfill the order book that they have right now currently in terms of the Vande Bharat coaches as well as the wagons. Then talking about the cash and bank balances, it is a stable growth overall in terms of the net debt. There's particularly no debt net. It's a completely net debt free company right now because the overall cash flow position is much higher than that of the debt that the company right now has. So in terms of balance sheet, we've given a thumbs up because steady stake in terms of equity share capital, the long term debt is decreasing, and overall cash flow, the overall cash position remains strong, which is why it's a thumbs up for the counter.
Well, let's also speak about the return ratios that we are seeing now. ROE, roughly stable numbers is what we are looking at in the last 2 fiscal years. ROE stood at about 16.5%, which increased to northwards up to 17.8% is what we are seeing. Return on capital employed also 19.5%, which increased to 20.4% mark that we are saying. Anything above 15 is considered as a better indicator for the overall return ratios that we are looking at. Net profit, as we've spoken about in the past in the income statement check, in 23-24 onwards, we have seen a significant improvement over there. So this one metric, these two metrics are overall on a good picture, and that's why we have given thumbs up for return ratios as well. But let's also talk about the cash flows, right, Mahima?
Right. So cash flow position for FY24 in terms of cash flow from operation, it stood at around 92 odd crores, which has gone to a negative 235 crore in first half of FY25. In terms of net cash flow, it stood at 286 crores in FY24. But it's come to around negative 260 crore in first half of FY25. But overall, if we check the trend of the company, first half of every financial year in the past 3 years, they have recorded a negative cash flow, but that turns into a positive cash flow by the year end. So we'll have to wait and watch out for as to how numbers pan out by the end of FY25. So taking a conservative approach, we've given a neutral rating to cash flow right now because overall net cash flow position as of FY24 ending stood at steady levels, but H1 FY25 right now the numbers are negative. That is why we've taken a neutral approach and given a neutral rating to the cash flows right now.
Right.
But what is the shareholding pattern looking like?
Okay, so here we have considered the last 2 periods of the shareholding pattern which is there. So promoter holding remaining stable at 40.4%. But if we go back and see the previous quarters also, now in September of December 2023, this used to be around 42.5% of a mix in terms of where the promoter holding is there. From June onwards, it's where we are seeing this number 40.4% of promoter stake which is there in the company. If you look at DIIs, now there has been a lot of market volatility. Railway sector is one of those sectors which have been in focus. A lot of price correction taking place here. FIIs mix have gone down from 16.32% to 13.67%. This is as of the December 24 data that we have. DIIs also, there's a pickup that we have seen making up from whatever FIIs we've seen a downtick over here. So 13.9% to 15.01%. Government holding almost 0.01%, almost negligible here, but still had to put it out there. Public, if you are seeing, they hold about 30.86% of the stake in the company, roughly similar as the last period, 29.25%. But if we see the December 23, that's the last year shareholding of the company, that stood at about 25%. So public shareholding has improved over here, while the FII mix, particularly in these 2 periods, is what we are seeing has gone down. So overall, considering these parameters, we give this a neutral rating, right?
Right, and also neutral rating because we've seen that the promoter holding has steadily come down. Now, if we see it in March 22, it was around 47%, which has come to around 40% right now. And FIs, as Anushi was mentioning earlier as well, at one point of time in December 23, it stood at around 20%, which has come down to around 13%, and that is because of market volatility. So overall, it's because of that reason that we've again taken a conservative approach here and given it a neutral rating. Moving on to what street cred and street coverage looks like in terms of the overall stock performance. 6 months, the shares have been down by about 33 odd %. 1 year, and of course, 6 months performance for railway companies definitely has been it's been the worst patch ever, because railway companies have corrected quite a bit. In terms of 1 year performance as well, it's down by about 11 odd %, and 5 years, the company has given returns of around 74 odd %. So that's with regards to where the street cred is concerned. In terms of street coverage, overall around 9 analysts are currently covering the counter, if I'm not wrong, Anushi, and all of them have buy calls, and the return potential as per Bloomberg is around 39 times. But what are the valuations indicating right now, Anushi?
Okay, so in terms of where the valuation picture is building at, so most of these counters that we are seeing have seen a major correction in terms of where the stock price is concerned. So Titagarh Rail trailing PE, if you look at, it's around 38 times is what we are seeing. Jupiter Wagons, its peer comparisons if we take in the similar space, 41 times, and Texmaco Rail around 21 times. So compared to the peer metrics, we are seeing almost a neutral rating over here in FY20. If we even consider the forward Ps which are there, 35 times is what we are looking at in terms of FY25 forward P. Jupiter Wagons, similar range around 39 times is what we are seeing, and Texmaco remaining at 21 times level is what we are seeing. So overall a neutral on where these peer comparisons are. Of course, these if you are looking at the multiples in the past, in the last 6 months or so, we have seen a significant correction because of the stock price correction also that we have seen, considering the outlook for the Indian Railways as well. So what used to be like a 50-60 multiple has now come down to these levels is what we are seeing for some of these railway names out there. But if you're talking about what's the outlook for the company, now the management did say its focus on some of the new verticals it wants to concentrate on, which includes the signaling and safety systems which is there, along with shipbuilding and maritime systems. In fact, we had asked the management about what is the outlook forward, and the next 3 years is something that we should be focusing on, the growth levers for these two counters which are there. Overall, if you look at the margin picture, they are targeting a 13 to 15% of a mix in terms of where the margins are concerned. In FY22 to 24, we did highlight that we are seeing margins in the range of 9 to 12%. So they want to improve this mix to 13 to 15% going forward for the business. If you look at what has happened with the Vande Bharat trains, now deliveries of these have been shifted to March 26. So that is something that we should be watching out for on the deliveries, on how the order book execution remains for the company. Now that remains as a key monitorable. Even if you look at the passenger rail segment, they have been clocking in revenue declines, but FY26 is expected to be a pivotal year for not just the passenger rail segment but also the freight rail segment as we speak. In terms of where the production is concerned, they are targeting about 1,000 wagons per month production versus current capacity of 800 to 900 wagons, and expect this to ramp up to about 3,000 wagons as we speak. So overall outlook for the company remains on a healthier side. The near-term concerns being about the offtake of the freight rail segment, which had been the better performing segment as compared to passenger rail. But so Q4 numbers would be awaited on more clarity on how the management commentary is on the same on some of these concerns which are there, right?
Right, absolutely. So the outlook definitely looks strong, and which is why we've given a thumbs up, and that brings us, to the end of the entire 8 parameters that we have calculated. We've given a thumbs up to the income statement, thumbs up to the balance sheet as well. Return ratios definitely on an increasing trend, and hence thumbs up. Cash flow, since for the first half of FY25 has negative cash flows, we've taken a neutral approach and given it a neutral rating. Shareholding, again a neutral there, because FIs and promoters have steadily decreased their stake, and street cred is a negative because the stock has seen significant pressure in the past 6 months as well as 1 year. Outlook in street coverage, definitely a thumbs up because the company has set out their particular guidance and outlook, which looks pretty strong. And lastly, in terms of valuation picture, it's at par with how and where the peers are trading. Of course, the 2026 picture looks better as compared to where the 12 months trailing stands at right now, which is why we've given a neutral rating, and the overall rating for Titagarh Rail turns out to be around 5.5 out of 8. Now, let's also shift focus and hear it from the management itself. Anushi earlier spoke to Titagarh Rail's Deputy MD, Prithish Chowdhary, who talked about the company's growth outlook going forward. Listen in to a slice of that conversation.
You see, Q3, as you rightly mentioned, there were issues in the rail wheel factory in Bangalore. What exactly the issues were in the factory are not really known to us, but there were issues, the production issues in the rail wheel factory, due to which the supply of the wheel sets for the Indian Railway contracts was slowed down. And as a result, the wagon production for Q3 was a little muted than what we had expected. In Q4, the situation has improved a little bit, wherein the production has ramped up. The railways has also taken certain steps to improve the availability of wheel sets, such as allowing for imports from China and things like that. However, the situation is still not completely normalized. We do expect that by Q1, by the beginning of Q1, the situation should come back to normal. Q4 has definitely improved as compared to Q3, but as I just mentioned, the situation should be normal only by Q1.
So considering that the impact that we had seen in Q3, what is the kind of trend that we are picking up for Q4? Would there be an impact on the business performance, on the revenue growth of the company for this upcoming 1 to 2 quarters as well, if you can give us a picture? And even in terms of production, are we still steady with our output of around 12,000 wagons per annum production? If you can give us a perspective on this aspect as well.
Sure. So our facilities and our internal capabilities are fully geared up to cater to the 12,000 wagon per annum production numbers. But there are sometimes external factors like the ones we've just discussed that kind of hinder that ability. So for this financial year, since we are almost at the end of the year, I would refrain from giving out any numbers for this quarter or for this year. However, compared to the previous quarter, the production has definitely improved. For the coming financial, we expect that since the situation would be normalized, we expect that we'll be in our targeted run rate of 900 to 1,000 wagons per month.
Okay, so 900 to 1,000 wagons per annum is the kind of, per month is the kind of production that we are still maintaining. But considering now the 9 month picture, if you see the numbers, revenue had seen about a 2% of an uptake, margins were in the range of 11%, while net profits saw around a 1% growth. So if you exclude the Q4 part and go to FY26, what is the kind of growth that you see in terms of revenues and the margin picture? You're seeing that the margin should be in the range of 13 to 15%. What would be the levers which would drive this margin expansion, and what is the kind of revenue growth that you're expecting?
Sure. So we normally do not give forward guidance and comment on future revenues. So I'll refrain from doing that. As far as the margin profile is concerned, in the FRS business, which is the wagon business, we've always maintained that between a 12 to 13% EBITDA is a sustainable level, and we will stick to that. On the PRS business, however, which is the passenger side, there is the possibility of expanding the margins up to 15%, but that only happens in a few years from
Mr. Chaudhary, can you also talk in more detail about the PRS segment that you've mentioned, the passenger rail? What's the kind of outlook that we are building for FY26? Because it's going to be a pivotal year in terms of where this segment is concerned. So just wanted to get your overall outlook in terms of the growth numbers here. And as you mentioned, 15% is the kind of margin expansion that you're looking from this segment.
Sure. So as you rightly mentioned, I think FY26 will be the pivotal year for the PRS business, because you see all our projects which have been in their design phase, which is the Ahmedabad Metro, the Surat Metro, as well as the Vande Bharat, all of them will start execution at different points in the coming financial. The Bangalore Metro project that we're doing with CRRC, the series production for that picks up right at the beginning of Q1 actually of the coming financial. So FY25 26 would be a very, very interesting year as far as the passenger business is concerned, because the revenues start coming in and the production starts ramping up. As far as margin targets are concerned, for this, for the next year and 2 years, we would not be targeting a 15% EBITDA, ma'am. We'd be looking at stabilizing at a 9 to 10% EBITDA. And this further expansion from 10 to 15% will actually happen on account of the backward integration that we're doing, which is the propulsion for the metros. But that absorption of that technology will only be completed by 27 or beginning of 28.
Okay, okay, that is quite interesting to hear about what's the outlook for the passenger rail segment. But coming to the overall order book picture, want to get your perspective in terms of the overall execution that we are seeing of the current orders, be it in the freight or the passenger side of the business. What are the kind of new order inflows that you're seeing? And also wanted to understand your sense of a pickup in the private ordering side that we are seeing as compared to the public capex side. So if you can give us an outlook on that as well.
Sure. So just about last month, we've announced, or maybe a month and a half ago, a new order that we received from Adani, from the cement. Similarly, we are very confident that a lot of the large cement players, steel players, logistics companies, and many private companies will have a strong demand going forward. But as will the railways, there may not be any immediate tendering, but we do believe, and in fact, this morning there were some media reports which stated that in the next financial, the railways estimates a 15% growth in capex. So we see a very strong pipeline for demand in both the FRS and the PRS segment.
Right, and coming to the new growth drivers which are there, which is the signaling systems and also on the shipbuilding and maritime side, want to get your overall perspective on these two segments. What's the kind of growth picture that you're seeing, not just in this 1 year, but even in terms of the long-term picture, let's say 3 to 5 years, if you can give us an outlook on these two segments, what's the kind of capex that you're looking for? What's the kind of margins that would be, is it in the similar range of what the existing business verticals currently hold? More perspective on these two segments as well.
Sure. Uh, so these two new businesses in the next year would not really contribute much to the revenue or to the bottom line because they are newer businesses which would have to be nurtured. The key metrics really to look out for these two businesses for the next year or year and a half would really be the order book that we're able to build, as well as the kind of partnerships or associations that we're able to sign. Now, as far as the potential is concerned, you see, as for the signaling and safety systems, this seems to be one of the key focus areas for the railways, for the Ministry of Railways, for the next few years to come. Enhancing the general infrastructure and safety infrastructure and the signaling infrastructure. So we see that market or that area as an area with a huge potential for growth. Similarly, for the shipbuilding, apart from just the domestic potential which the Indian market has, which is very evident because of the focus that the government is also putting on the sector right now, the international market or the export market would be very interesting to look at. As you're probably already aware, roughly 90% of the world's ships are only built in three countries. And India has a huge potential to kind of break into that market and establish itself as a leader. So that's the angle, or that's the vision that we have for this segment, for this sector. And the detailed capex plans, etc., I would share with you as time moves along because we're still deliberating on those internally. So I'll refrain from sharing too much.
Okay, that's fair enough. So, considering that this is the kind of outlook that we are building for these companies, just wanted to get a margin picture sense as well. If the margins are going to be in the similar line as the two verticals which you currently already have, if you can share more details on that.
As I mentioned, ma'am, we are currently formulating our business plans and our growth path for both these businesses. So I will refrain from sharing too much on these. However, if you look at the global trends for other companies who are in these segments, the EBITDA profiles generally tend to be a little bit higher than our two existing businesses. So that's just the way the market is. But what our plans are and our expectations are, we'll share with you as time moves forward.
Sure. And my final question to you is about the ongoing participation in the various metro tenders that you currently have. Wanted to get your sense on what's the kind of outlook, some of the key new orders that you're bidding for are already in pipeline. If you can give us an outlook on this.
Sure. So there are tenders for Mumbai which are live. There is a tender in Bhubaneswar that is live. Just a few days ago, we were reading in the news that new tenders for Gurgaon Metro are going to come out. So the metro market is booming in India, and it will continue to boom for the next 5, 6, 7 years. Because you see, every week we wake up and we read the news and we see that some city has either announced an expansion of the metro lines, or they've announced a new metro altogether. So the metro market is very interesting in India, and we are keenly awaiting the outcome of the Mumbai and the Bhubaneswar tenders, which we hope would be clear in the coming weeks or months.
All right, so that was the management of Titagarh Rail indicating as to how the roadmap of the company looks like. But with that, we're completely out of time on this edition of Know Your Company. But stay tuned for more news and updates on the other side.